Hey everyone, welcome back to Keeping It Capital, the show where we break down credit, crypto, and payments to teach you how your money actually moves. I'm your host, Ethan, and I'm really excited about today's episode. Before we get into it, I want to set the scene a little bit, because today's conversation, we're going to be covering some topics that you might not have heard of in your everyday life. Think about the last time you sent someone money. Whether it was paying rent, paying back a friend for dinner, or even paying a company payroll. It might feel instant to you, but in reality, it's not. Whether it's clearinghouses, settlement, this process can take up to days. Maybe even one day, potentially even 2 or 3. In some cases, it can take even longer, especially if it's crossing a border. Today, we're going to be talking about that friction with our very first guest, Colin Coulter. He works for an organization called FinRegLab, an organization that focuses on financial innovation and regulation, especially how it applies in the policy space. A few of the topics that we're going to be covering today is stablecoins. What are they? Where do they play? And where do they focus in the overall payments industry? And we're also going to be talking broadly about the payments industry itself. What is it, and where does it matter for you in your everyday life? Even though we've talked a lot about cryptocurrency on this show, today really isn't a cryptocurrency episode. It's a story about money, and money affects everyone. All right, let's get into it with Colin and our very first expert on keeping it capital. Welcome, Colin, to the first episode with an expert guest on Keeping It Capital, technically our third episode here today. We're here to talk with you about stablecoins and the payment industry. Basically, where traditional banking and cryptocurrency intersect. Before we get started with going over some of the concepts that we want to talk about today, why don't you give us a quick overview of your role in your current profession and how did you develop an interest in the payments industry? And then how has that informed your understanding of cryptocurrencies, just broadly speaking?
Yeah, well, thanks again for having me on. I really appreciate it. I love payments because they're super cool. Yeah, I think it's the laziest way to answer that question, but I think I got into payments mostly because I had to. In one of my kind of first careers, I was working for a university and doing some of their kind of international programs, gov relations, and research partnerships. And I covered India and Latin America mostly, but kind of all over the world. And we had to essentially establish a separate legal entity everywhere we did business just to get bank accounts. And it's a different legal entity in different countries. The idea of a nonprofit like university is separate in different countries, right? And so it was this huge effort to just pay people on the ground or to get office space or, to convert currency. And some of these countries have capital controls. And so I became very confused, frankly, about this opaque wiring that seemed to be everywhere that I couldn't like figure out. I was just wildly unmatched for figuring out what the economics and the technology behind it all. And so when I went to grad school, I tried my hardest to really focus on financial markets. And quickly, frankly, got pretty bored with the economics of it. Like, I was just like, okay, some people out there make a lot of money. Here's a bond duration. This is interesting or whatever. But I kept trying to dig like deeper and deeper and deeper and say, like, how does it actually move? Nobody can explain to me how does this dollar go from here to here and why is it different, on your computer on this server versus this server in this country versus this country. And so I got deeper and deeper. And through a professor friend, actually ended up on a project with an East African country on their digital ID system and learned a lot about how IDs and payments in the financial system interact and the role of kind of identity. And that got me into some fast payment systems. There are, any number of frontier markets around the world building some pretty innovative fast payment systems, and I'm sure we'll talk about that later, but they're not encumbered with the legacy architecture that we have in the US and Western Europe, and to a lesser degree in Japan, Korea, Taiwan, Australia. And so they get to build new. And so they can kind of rethink a lot of the challenges that we face in other parts of the world. That led to a series of contracts. So across your multilaterals, your development banks, your WTOs, IDBs, you name it in that world, and then ended up at the World Bank in their fast payments group. So FAST stands for frictionless, affordable, safe, timely transactions. It's a terrific group. I worked under a guy named Holti Banka, who one of his claims to fame was his PhD was coming up with a cost of running cash. So how much does it cost you to run cash in an economy? And his estimates were upwards of 2% of your GDP. And so being able to digitize some of that work could vastly cut your costs running essentially your monetary system. So got to learn a lot with them as they advised central banks and regulators around the world. And then this summer was fortunate enough to join on with a nonprofit, nonpartisan research organization named FinReg Lab. We're based here in DC that builds and studies technologies to inform market practice and regulation. So I do any number of different projects for them, but always around kind of payments and AI. And it goes without saying, but any, of course, opinions and thoughts I share tonight are my own, no reflection of any of my clients, past or present, and definitely not of current employers. Nothing should be construed as investment advice. You can find better advice online, I'm sure, but do your own research. And so through that long kind of winding dig of like what's actually going on here, I found myself deeper and deeper into questions of how humans actually move money online.
No, definitely. Yeah. I've always found it tricky just, as someone also in the payments industry, and I'm going to echo your little financial disclosure there. This is definitely not expert advice coming from my end or any legal financial advice for that matter. It's I've always found it tricky to actually describe like what the payments industry is. To me, the word that often comes up, but also requires a little bit of explanation, is remittance or the process of sending money to another person or entity. But for our audience, broadly speaking, could you define the payments industry in a sentence or two?
Yeah. There's probably two answers. The first,
Okay.
similar to what you just said, right? A system of rules, regulations, and entities that facilitate the movement of messages and fiat between different actors. So banks, card networks, card issuers such as banks, increasingly maybe it's crypto exchanges, it's merchants, and it's individuals with bank accounts like you and me, retail users.
Hmm.
On another level, a payment system is the largest possible group of people you can exchange value with whom you don't know um, in a trusted manner. And so I think if we think through a layer of like, what's the trust aspect of can I give, let's say, Starbucks down the street a tap of my phone? They trust that they're going to get paid later on. We
Hmm.
can go through how that model works because it's not, we kind of have the experience of fast payments in the US right now rather than real fast payments. But there's a trust layer to that that comes from partly regulation. It comes from some industry standards. Industry's really been forward on this, but I think the trust layer is really important.
No, definitely. And that's really interesting. In some of our Substack posts, that's something that we've talked about is kind of that delay component that does come with payments. So like when you tap to pay, it's basically, it is that trust layer, and that's really all it is because the money doesn't necessarily get sent in that moment. It takes a process of batches, and that's how it gets sent from your bank to the merchant's bank. Want to focus on the latter part of our topic today, which is stablecoins. So, I heard you mention some of the intersection work that you were doing internationally between digital ID systems, as well as trying to speed up um, the velocity of payments. Is that where you started to run into stablecoins?
Maybe.
Okay, fair enough.
Yeah, I mean, on a higher level, like fast payment systems, and especially at a group like the World Bank, they're truly agnostic. They really just want to be descriptive when they're helping countries on a mission to just say, here's how this technology works, make your own kinds of decisions.
Hmm.
I mean, we can talk about CBDCs or anything else like that, but ideally, they're all trying to solve the same problem, right?
Right.
Low cost, real time. Notice I'm not saying instant, but real time availability
Hmm.
of funds. Um, and oftentimes, ideally, your national unit of account. And there are lots of different ways to solve those problems. And then when, the Trump administration came in last year, that's when stablecoins really became a kind of national conversation. So we'd had um, hints of regulation around the world, whether it was the Bank of England's guidance, or I guess I should say the FCA's guidance, or anything from the EU with MiCA, the markets and crypto assets. And then slightly more stringent work, whether it's in Japan or Singapore around like domiciling reserve assets. That's really when I was like, I should probably dive into this quite a bit more because there's a layer of like, okay, does this interact with a national payment account like in a low or moderate income country? And that's something that we'd worked with quite a bit. especially as it relates to central banks. And then there's a question of does this um, supplant the national unit of account as people hold this external, I call it payment instrument, a stablecoin in lieu of their domestic currency.
No, I've always found that piece of it a little bit tricky to navigate, just from like a conceptual understanding point. The one thing that I think about when I hear stablecoins is the Genius Act in the United States, especially how issuers of stablecoin need to hold that one-to-one reserve ratio under the Genius Act. So holding the same amount of US dollars as stablecoins. Um, I know you just said that the economics wasn't super interesting to you, but how does that necessarily translate from like an inflation perspective? Like, is there any worry that the creation of stablecoins necessarily is potentially inflationary because you do have to hold those reserve assets in place?
I would never say that the economics are not interesting. I think let's just go through like Genius real fast. When
Sure.
we think about that one-to-one reserve holding, almost every stablecoin legislation I've seen, of course, is going to have this one-to-one parity for every asset of national account, whether it's a euro or a pound or a dollar, you can issue one kind of tokenized representation of that goes onto a different chain, Ethereum, Tron, whatever, and that's where the actual ledgers are updated through those smart
Hmm.
contracts. The stablecoin issuer, whether it's your Tether, or USDC, or your Circle for USDC, um, they have to hold those reserves into what's called high quality liquid assets. And those can be broken down into different tranches depending on your liquidity needs, typically from like the most liquid to the least liquid needs. And so there's some open debate about what's the optimal ratio of all of those right now. Right now, it's overwhelmingly kind of US treasuries, US debt instruments.
Hmm.
And that's the real economics of stablecoins that I think if we don't wrap our heads around, we won't understand a lot of the risks. Stablecoin issuers make their money off yield on US debt, right? T-bills.
Hmm.
So 4.5%, 5%, depending on the duration of what they're holding. But they can also hold any number of other cash-like assets, cash and cash-like assets, all the way down to like actual cash deposits. For example, in the UK, the Bank of England, they have a fairly high ratio. I think it's like 40%
Hmm.
of a stablecoin issuer's reserves have to be held in custody at the central bank. So I believe at the Bank of England, and they're not remunerated, which means that the central bank doesn't pay an interest on those deposits. So it's
Huh.
just cash sitting there. And so if you're an issuer, you're like, this is wasted money because I only make money by investing in government debt,
Right.
that national unit of account. And so that's felt as like a very punitive thing. If you're the central regulator or the central bank, you're saying, no, I want you to be able to meet almost every possible demand for your, I'm not going to call them a deposit, but for what you've issued, I need you to be able to meet demand when people ask for it. And so they can set rules, say, well, you have to meet that within a day or whatever. And so that combination of the, let's say, like delay and stickiness between when somebody can get their money out, right? You or me, if we go through an exchange, it actually can be a little bit of a delay versus the economics of where up market are issuers incentivized to hold, depending on, I guess in this case, in your question, inflation, if they have to hold longer duration assets to actually make any money, um, that would theoretically change some of the liquidity that they're trying to balance against. And so I think it's an open question, frankly, depending on, how interest rates in the US fare in the future as to whether or not a scale stablecoin issuer can really thrive and meet the kinds of demands that they're, need internally and operationally in a low interest rate environment. And so I'm kind of taking your question, I'm flipping it on itself, right? Where, how does inflation affect this? And therefore, interest rates that the government has to pay that yield, the coupon rate on their debt. But some of that core economics of what makes a stablecoin issuer work, I think are still an open question.
No, that's definitely interesting, and I really appreciate the macroeconomic perspective. And I appreciate you noting that even though that's not necessarily your area of expertise, definitely something worth being interested in and tracking. Now, kind of on a more personal level, when we're thinking about stablecoins within the payments industry itself, How, where, and why are they showing up and in payments, just generally speaking?
If you are US based,
Hmm.
you're retail, so you're not a business, and let's say you're not sending money abroad,
Hmm.
the chances you're interacting with a stablecoin are pretty slim.
I kind of figured as much.
Right now, the numbers are very, very low. Most of stablecoin transaction volumes, um, I think it's right now it's like 33 trillion total annual volumes for Tether and USDC combined.
Oh, wow.
Something like 2/3 to 70% of that is mostly bots. So
Hmm.
buy algorithmic trading, microtransactions, which leaves something like 10%, I guess, or 10 trillion that might actually be payments.
Sure.
But then we have open questions about where those payments are happening. A lot of that happens, I think, to be mostly on Tron network through Tether, which
Hmm.
to me implies, right, strong implies that this is mostly being held in foreign markets outside the US. Reminder, Tether is domiciled in El Salvador, and they're trying to reissue some kind of entity through Cantor Fitzgerald in the US, and I have yet to see too much more news on that. But the takeaway is most stablecoin transactions right now are still for crypto exchanges, right? Going between different crypto assets. Maybe I'm using it to actually buy Bitcoin,
Right.
Doge, or whatever
Hmm.
meme coin you have these days, or XRP if you have some thesis, or a hype if you have a thesis about perpetual exchanges. However, there's some new good BIS, Bank of International Settlements, work that looks at kind of like Forex flows and how much of this would actually be a cross-border, um, I guess you'd call it a transaction at that point.
Hmm.
So slightly open question, but if you're sending money to, let's say, a relative as remittance through a major remittance corridor, but it's still quite expensive, where you know the address at the other end, you've, let's say, diligenced in your own way who that person is, and you trust that if you send it to this wallet, it'll get there. Maybe you're doing stable coins, or you think this would be the best possible way to do it. But as of right now, it's not paying for your cup of coffee.
Got it. No, that makes total sense. And I think, as I did research for this episode, that's kind of where I figured the main like personal use case would lie is in that person to person cross-border cross-border payment network. Now, curious about um one of the things that you mentioned is, there has to be that high confidence. Is that when we're talking about that trust layer in payments broadly? Is that kind of what you're referring to?
Yeah, absolutely. Yeah,
Hmm.
100%.
Yeah. No, that makes a ton of sense, especially considering the actual security around holding your own self-custody wallet. We actually did an episode on that previous to our first interview. So if you folks that are watching this now want to go check that out, you guys are more than welcome to. Now, moving on to some of our more consumer-focused questions. I know we just discussed that cross-border payments are probably where you're going to see the most visibility, but is there a situation where the average consumer would interact with the stablecoin where they might not realize it? To me, one of the things that I'm thinking about is like, say someone has two JP Morgan Chase accounts and they're moving money from one account to another. JP Morgan Chase, I'm pretty sure they've got that proprietary deposit coin on their end where you can actually earn interest off of. So, quick distinction for those of you in the audience, it's not technically a stable coin, or at least to my knowledge, it's not technically a stable coin. But my understanding would be that that's potentially somewhere that could play in.
Yeah. No, absolutely. And I think the big banks, you're totally right. The big banks are like, if we keep this within our network,
Right.
then JP System, which is a behemoth system, and they're one of the world's largest correspondent banks, so we can talk about
Hmm.
correspondent banking later on, is you're just going from client account to client account. I think it's JPMD is their tokenized deposit.
Hmm.
So it's a deposit that's already insured, FDIC insured in the US. So it has this regulatory backing over it. They're supervised, they're examined by their prudential regulators. If you're JP, you have an enormous amount of buffer built in, regardless what happens with kind of what you see right now with different supplementary leverage ratios, right? The ratio of assets to liabilities on hand at these large banks. If it's all in network, you already have the regulations around deposits. Here, tokenization is just a way to digitally represent ownership of that deposit. right? And whatever unit you want to break it down into, that lowers the cost, from what I can tell, significantly. But I don't know how they would jump between, let's say, a JP coin and a Citibank coin because they have that same redemption problem and
Right.
don't want to interact. Ironically, a lot of this is what networks, right? Sometimes called card networks,
Hmm.
which is a little confusing because they don't issue cards, right? MasterCard doesn't issue cards.
Right.
You know this, of course. Uh,
For what it's worth, context for the audience, there are two issuers, or sorry, two networks rather, that do issue cards in the United States. That is the Discover Network as well as American Express, and they do issue cards. The other two that we're going to be referring to is MasterCard and Visa. Sorry to cut you off there.
You're good. That's essential. And another reason why like Capital One bought the Discover Bank because they want
Definitely.
to issue and have that network at the same time. But no, I was just gonna throw in this idea that like one of the reasons these networks exist is because they solved a problem between merchant banks and retail banks,
Hmm.
right? They're like, you want to be able to accept digital transactions, but you don't want to share information about your customers. And so what has become Visa, originally Diners Club, there's a great acquired podcast episode on the history of Visa. If you're interested, you can dive into it. It's like 4 hours. Realized was, hey, so we're going to build out a consortium of banks. You're all going to essentially own us. We're the network, and we're going to share the tiniest amount of payments transmission data that you would need in order to just settle this.
Hmm.
Because if you're the issuing bank, you run the risk of non-payment, right? How do I know I'm going to get paid at the end of the day? I just have to trust these rules. And so a whole kind of infrastructure of rules was built around that, around chargebacks and fraud and what information you have to share when there is a dispute when a customer says, hey, I didn't make this payment. And then you have to say, well, who did? And you're like, well, I gave my son my credit card. And so, well, that's technically actually your liability because you handed your card over. He's an agent of you or whatever.
Ah,
Point is, networks came in, solved a problem between two entities who didn't want to share data, didn't want to share information on their customers, and scaled it. And as a result, we see the volumes that they have. Their reward was they said we're going to take a tiny percent of this interchange. Issuing bank takes most of the interchange.
right.
And now we're seeing this kind of fragmentation in other payment systems where it's like everyone wants to, let's say, have a deposit token. You still have to figure out how to make those interoperate with each other. Or if you want a stable coin, say, well, it's on this chain, but not this chain. How do you trade those at par in a cost efficient way? So there's still big questions.
No, definitely. Want to touch back on one of the things that you mentioned, correspondent banks. That was another topic that we did feature in our primer Substack leading up to this episode. So my understanding of correspondent banks is those are the intermediate players that come into play when you are trying to make a cross-border payment. And I'm thinking, am I thinking about that correctly when it's specific to cross-border payments?
Absolutely.
Okay, cool. So those correspondent banks, they have to necessarily interact with each other because they have to hold local currency amounts and also foreign currency amounts to be able to process those transactions. But would really appreciate if you could help me understand it a little bit more in depth.
Yeah, yeah, absolutely. A couple of this, like one of the big drivers of the correspondent banking network is the demand for US dollars and how much trade is settled in USD.
Hmm.
Maybe you'll have another podcast on like dollar dominance and what does that mean and where do you find this? But in trade, in oil, you see a lot of that being done in USD. And so there's always this demand going cross-border oftentimes for goods or services to actually be able to use US dollars. Because you want to use US dollars, oftentimes that means you are under the purview of US regulatory oversight law and in post
Hmm.
really, especially post 9/11, you have a much stronger push for anti-money laundering, countering the financing of terrorism, and then, of course, just your general BSA, KYC, so Bank Secrecy Act and no
Right.
customer
Know your
laws
customer. Hmm.
that drives a kind of operational regulatory overhead. And so, with that in one part of our heads, we can go to the kind of mechanics of correspondent banking. And the first thing I would always, remind folks is that as of right now, in general, cross-border payments don't exist.
Hmm.
What do I mean by that is like it's quite rare for money to go, let's say, be printed and then flown across the world. Maybe you're moving gold bricks back and forth like they were doing pre, Liberation Day tariffs or whatever. That's super rare and it almost never happens. Why? Because it's inefficient. One, two, it's not super safe. And so what you actually see is you have banks. Let's say there's an Ethan bank and there's a Colin bank. And instead of me coming all the way to your home and saying, hey, I need to exchange some money, we each keep accounts for each other. So I
Hmm.
have, let's say I got 20 bucks of, we'll all have, in this case, dollars, and that's Colin's account, and you're going to have 25, and I owe you $6. Instead of me putting it in an envelope and mailing it to you, which is risky, who knows? You could open that package. And for the longest time, we didn't have advanced enough messaging systems to be able to do that. What if I just took five out of my account and put it in yours? And then you would keep track of this as well. And you would say, well, I know that in my account in Collins Bank, I now have more money or whatever. And so in your systems, you're managing that, but there's no really that much money going between us.
Right.
Um, that's the vast majority of, let's say, cross-border payments. That's what, when you're outside the US at least, is mostly governed by SWIFT, the Society for Worldwide Interbank Financial Telecommunications. SWIFT doesn't move money, they move messages, right? They send a message from bank to bank B and they say move, this much from a Nostro to a Vostro account,
Hmm.
our account to your account.
Hmm.
Most of them settle depending on the kinds of transaction within 30 minutes. It's not that slow. It runs the gamut. Some of them are T1,
Right.
but in general, the correspondent banking system, because it moves two separate things, right? A
Hmm.
message, and then internally you're adjusting a
Hmm.
lot. Plus, if you're doing this in dollars, that means you're under regulatory perimeter. So what? I have to adhere all these things to say, I know that this account, this bank is
Hmm.
approved. I have their IBAN or whatever, and I know that they're not some sanctioned entity in the US that's going to get me cut off from the dollar network. So if I can't be part of the dollar network, I can't be part of global trade, I can't be part of all these other things, which means all the entities within a country are trying to use that bank might also have trouble because then the US can say, well, what about this group over here? Or do we know that this entity is legitimate? And if you're a low income country who's, maybe you've got lots of small businesses, or maybe you have trouble with transnational crime or whatever, that puts a lot of heat on you and it makes it really hard to conduct international transactions. And the harder it is, the more expensive it is because the more time these correspondent banks have to spend on diligencing every possible payment so that they don't end up under the chopping block of the US Department of Treasury.
And that's not a chopping block I'd necessarily want to be on.
No, never. They'll come for you.
All right. Well, Colin, thank you so much for your time. We're just about up on time today. So really quick before we close out here, I know you had some articles that you wanted to drop for us to get to our audience. Super excited to read through those myself. Send those my way when you get a chance. Last and final question for you today. If there's one like consumer takeaway, what's like one thing that you want our audience to take away with after listening to this episode?
Maybe I'll give you two answers and just steal your time a little bit. A
Fair
consumer
enough.
takeaway is with different payment methods and different, let's say there's litigation with card networks and stuff that was just settled. I think consumers have to think really carefully about what payments they want tons of service layers on top of. You need the 3% interchange cost on a cup of coffee or on something more expensive that you buy online, right? Those have different risk windows. And I think we're going to see a lot more fracturing in the US along how much effort a payment service provider or a network is going to be willing to put into each one of those, depending on the risk that the customer says, I didn't actually buy that, or I didn't, I got scammed or defrauded or whatever, is one. And two is I think there are some central tensions between how the economics of a stablecoin issuer work, how they would interact with each other and maintain the singleness of money, and actual kind of monetary systems as we've built them right now. I'll show one of these papers on the currency franchise. And if we can't figure those out, they're going to maybe drive further discussion.
No, definitely. Yeah, well, I'm super excited to check out some of those articles that you're going to send over, and I really appreciate your time. Thank you so much for being willing to come on our episode as our very first guest expert. Yeah, you can check out excuse me, you can check out our episode on Spotify. You can also find us on YouTube. Also, subscribe to our podcast if you want primers for these episodes. And Colin, thank you again very much for your time. Yep, this is Keeping It Capital.